For as long as there's been a stock market, there's been this one single timeless challenge. How do you navigate all the chaos without getting completely wiped out? It's a huge question, and it's what drove two brilliant thinkers almost a century ago to write what many still call the Bible of investing, security analysis.
And look at this, right from the very beginning, they kick things off with this incredible warning. They're saying the biggest danger in finance isn't a market crash, it's not about economy, no, it's our own obsession with what's happening right now. The superficial and the temporary. That was their big concern then, and you gotta ask, isn't that even more true today?
Now, to really get what they were trying to do, you first have to picture the world they were living in. They weren't just writing this from a comfortable office in a booming economy. They were writing from the absolute heart of an unprecedented financial wilderness. I mean, just try to wrap your head around this. Between 1929 and 1932, the Dow Jones Industrial Average lost a jaw-dropping 87% of its value. 87%. And by the next year, 1 in 4 people in the country was unemployed. This wasn't just a market dip, this was a complete and total meltdown of the financial world.
So out of the ashes of the Great Depression, this question was forged. And it's a question that every single generation of investors has had to face ever since. How in the world do you find your way through all the noise, all the volatility, and not just survive, but actually come out ahead?
So into this complete and utter chaos stepped 2 professors from Columbia University. They just believed there had to be a better way. They wanted to create a logical, rational framework, basically a map for all the investors who were lost in the wilderness.
And that map, well, that became their book, Security Analysis. Now, they weren't trying to predict the future. They weren't looking for some secret formula. Nope. They were simply trying to apply logic and really rigorous analysis to a field that was, let's be honest, completely dominated by emotion and wild speculation.
And if you need any proof that their map actually works, well, listen to this. Warren Buffett, who's probably the most successful investor of all time, called it the roadmap he has followed for his entire career. I mean, wow, what a stamp of approval, right? So where do you even start on this map? Well, the very first turn, the first rule of the road, is this massive, massive distinction that changes how you see everything. It's the difference between investing and speculating. And this right here, this definition is the bedrock for their entire philosophy. Just look at the key phrases. Thorough analysis, safety of principle, and a satisfactory return. It's methodical. It's businesslike. And they're saying if what you're doing doesn't meet all 3 of those criteria, it's not investing. It's something else. It's speculation.
And you couldn't have 2 more different approaches, really. See, investing is all about analyzing what you have in front of you today to make sure you protect your money and get a decent return. Speculation, on the other hand, is basically just a bet on what the price is going to do tomorrow. It's all about predicting market psychology, and it's missing the single most important defense an investor has.
And that defense, well, that's the absolute core of their entire approach. It's a concept that's so simple, yet so incredibly profound, and it's the best way to manage the one thing you can never, ever escape in the market: uncertainty.
The margin of safety. Just think of it like this. It's your buffer. It's a cushion. It's the safety net that protects you when, not if, but when your analysis is a little off, or you just get unlucky, or the market decides to go completely crazy for a while. You are deliberately building protection right into the price you pay.
And probably the most famous way to think about it is this. You're trying to buy $1 worth of a real business, but you're only willing to pay 50 cents for it. That gap, that whole 50 cents difference, that's your margin of safety.
So here it is visually, and it's super simple. On one side, you have what a business is actually worth, its intrinsic value. Let's call it $1. On the other side, you have the price the market is quoting you for it, maybe 50 cents. Your job as an investor is to find the biggest possible gap between those two. That gap is your margin of safety.
Okay, so to actually find that gap, you have to make a really important mental switch. You have to truly understand that the price tag the market slaps on a company on any given day is often completely disconnected from its real underlying value.
And Graham had this amazing way of describing it. He said that in the short run, the market is a voting machine. It's just tallying up what's popular and what's not. It's driven by emotion, by hype, by herd behavior. But in the long run, he said the market becomes a weighing machine. It ignores all the popularity contests, and it precisely measures the substance, the actual value of a business. Your job is to take advantage of the voting machine's mood swings to buy things for way less than what the weighing machine will eventually say they're worth.
And what that means is a fantastic company can still be a horrible investment if you pay too much for it.
The price you pay is absolutely everything. A stock isn't just a good investment, period. It only becomes a good investment at the right price.
All right, so we've gone through all this. We're getting to the end of the map. So what's the ultimate takeaway from this 75-year-old masterpiece? What's the big secret that has guided some of the world's best investors for generations?
Well, here's the crazy part. The big secret is that there is no secret. As Seth Klarman, who edited the 6th edition of the book, put it so perfectly, every single important principle of value investing has been out there in plain sight since 1934. The ideas are simple, they're clear.
So you have to ask, if it's all out there, why on earth does it still work? Well, it's because of us. It's because we're human. The principles might be simple, but following them is incredibly hard. Our collective desire for instant wealth, our deep-seated fear of going against the crowd, and that obsession with the superficial and temporary we talked about at the start, all of that ensures the market will always misprice things, creating opportunities for those with the discipline to stick to the map.
And that brings everything full circle, right back to that first fundamental question from Graham and Dodd. It's not really about what the market is going to do tomorrow, it's about what you are going to do today. Are you doing the hard work, the thorough analysis, to protect your principal and get a satisfactory return? Or are you just betting on which way the price will move? So you have to ask yourself, are you an investor